Welcome to the Brisbane Property Podcast with your hosts Melinda and Scott Jennison.
Hi everyone, and welcome to another episode of the Brisbane Property Podcast. My name's Scott Jennison. I'm the Acquisitions Manager here at Streamline Property Buyers, and today we're joined by I'd probably call a bit of a regular in a way. Been on the podcast episode 10 and episode 111. We've got Mike Mortlock from MCG Quantity Surveyors. Welcome, Mike.
Thanks for having me back. Does episode 10 make me a foundation member or something? Do I get any perks?
Pretty much. I mean, when we first started the podcast, I do know that we reached out to our handful of connections that we had 3 years ago, and you were one of them. So it just goes to show how long our professional relationship has been going on. And you added a lot of value in that first episode. It was back in just post-COVID. I think we were all in lockdown, and you were talking about depreciation in Brisbane properties. So for any listeners that haven't already heard that episode, head on back to episode 10. You'll find out a lot of very useful information about depreciation in Brisbane properties. And I know we specifically talked about character Queenslander homes and how that might be different to other properties interstate. So lots of value. And then episode 111, we talked about some data that your firm had actually put together, and that was unpacking the 1,000 assets report. And I'm excited to say today that you've actually put together some exclusive data that we're going to share once again on the Brisbane Property Podcast, and that is in relation to trends and observations that have occurred over the last couple of years here in Brisbane based on your the data that you have in-house. That's right?
Yes, you're hearing it here first. Exclusive, world exclusive. So no, it's great. I love unpacking the data with people like you guys, especially with yourself, Melinda, with a PhD after the name. I mean, I really rely on clever people like you to unpack, the mess of stuff that I normally dump on your desk to sort of tell the story behind it. But no, I'm looking forward to unpacking some stuff today with you.
I know what you're talking about, Mike, because I'm the same. I sit and wait for Melinda to unpack all that data and all that mess, and then she can deliver it to us in the team, and away we go. So, look, I have had a look through some of the information you've sent through, and thank you, obviously, for contributing to the podcast and the information you do send. You've helped us go to #1 podcast in Brisbane, by the way, just so you know.
Awesome. That's my sort of strategy is to cherry pick talent and then sort of ride on the coattails and claim, a percentage of the success. So you guys keep charging ahead, and I'll rest on my laurels.
Look, Mike, I'd love to get straight into it because some of the information that you've shared with us, it's very, very interesting. And in fact, it's a little bit damning in some instances, and probably the data that's most disturbing, I think you could call it that, is the change that you've noticed in terms of the number of investment properties being purchased here in Queensland and how that's changed over the last couple of years. And we'll talk to some of the reasons why that might have been the case. But from the information that you have access to, help us understand how purchase numbers in Queensland have changed just over recent years.
Yeah, so to give you a background, we prepare tax depreciation schedules for property investors, right? Across the country, there are certain pockets where we're stronger. So, for example, we do much more work on the eastern seaboard, but we're certainly growing in WA as well. But we were able to find a way to sort of statically measure the investment percentage. So we're looking at the percentage of people that buy in Queensland as opposed to other states. And about 6 to 10 months ago, I spoke at the Accounting Business Expo and presented some data that Queensland was the favourite at 34% of investors were buying into Queensland. Compare that to, say, Victoria, which was around 11 or 12%, and New South Wales somewhere in the middle. So we've been crunching that data for some time. That data actually went quite a bit higher than that. We peaked at 40.9%. But My little sort of thought experiment was looking at the land tax changes that were proposed, and there was a period of time where I heard anecdotally that people were avoiding Queensland, because we must remember that the land tax change was legislated, right? It wasn't just a proposal, it was actual law that was due to come in. So I was very interested to see what happened during that period, because anecdotally I had buyers agents and investors saying we're moving out of Queensland.
Yes, and for those that can't recall that, whilst the legislation did come in, it hadn't yet applied, and the proposal or the legislated requirement was that any property holdings Australia-wide would contribute towards the caps to calculate land tax here in Queensland. So there was a lot of industry uproar around this legislation, and as a result, it was actually withdrawn and overturned. But at the time, it actually caused a lot of uncertainty for property investors, especially property investors that had specifically looked to diversify portfolios across multiple states to actually avoid additional land tax liabilities. The Queensland government wanted a bigger piece of the pie effectively. So from what you're saying, Mike, it hit a peak in terms of the number of investors buying into Queensland of 40.9%. From your observations and the timing of how this all played out, what percentage did that drop to after the Queensland land tax legislation was proposed?
Yeah, let's talk quickly about that timing. So it came in 22nd, 23rd of June. At least it was legislated to come in 1 July this year, and it was repealed on the 30th of September. And the government didn't really say we've taken it away because we see it as bad policy. They sort of said, well, we're going to repeal it because the states aren't going to help us to grab that revenue. So, that I think has some interesting implications. It's not that they admitted it was a bad idea. They were just saying, well, we can't make it work. But over that 98 days, what we did is we allowed for a typical 6-week settlement period to try and say, look, these would be people that are aware of this and are making a decision with the full knowledge of it. And we saw that it dropped by 10.1% in that 98-day period, which, there's all sorts of things that could factor into that data, but such a big jump in such a tight period. And we looked at the preceding sort of, I think it was from that point onward, it was about 230 days. We looked at the preceding 230 days on top of that 98-day sample, and the numbers were quite identical. So to us, that was pretty clear evidence that the land tax change made investors avoid Queensland.
So these investors were not investors that, just decided, well, I'm not going to buy. So we can't sort of suggest that the rising interest rate environment, as an example, was the reason that they didn't actually purchase. What you're saying is that these investors actually took their investment dollar elsewhere. They purchased in another state, and based on the long-term trends of the buying habits of your client base, the number of investors buying an investment property in Queensland dropped by 10%. That's big numbers.
Yeah, that's a really, really important point, because let's say, because people have asked me that question, well, interest rates up, well, people just weren't buying. Well, we adjusted it for volume, right? So we were looking at the total number of purchases across Australia, and whether that went up or down, the percentage buying in Queensland was still going to be the same. It was still as statistically robust as we could get it. Yes, it is a very a tight time frame, but we're talking hundreds and hundreds of transactions that we're analysing there. So yeah, I think it's an interesting insight. I probably shouldn't say that about our own data, but I guess I look at this stuff myself just excited to see, well, what story can this tell? And I thought it was interesting, and I thought it was interesting enough to share with people.
Absolutely.
So Mike, does it line up with the core logic data that you look at? So obviously the information that you've got in your in-house data, when you start to compare that with core logic, does that sort of align with that as well?
So when we look at...
I was just going
to say, just to elaborate on that, the CoreLogic data that Scott's referring to is the information that shows that a higher proportion of investors who are assumed to be selling properties. So based on the listing numbers, those properties that are listed for sale, there's been a higher portion of investors that have been selling out of the Queensland market. Now that hit a peak in 2021, which was the post-COVID boom. However, the long-term trend for the proportion of people selling properties here in Brisbane it's still a higher portion today compared to pre-COVID levels. And if we look at the numbers, 28.8% of investors still selling out of the market now compared to the pre-COVID average of 26.3%. So interesting that, some of this proposed legislation, yes, it was withdrawn, but it seems to have some alignment. Would you agree?
Yeah, I think so. I think it lines up fairly well that people are, yes, they could be locking in some of the COVID profits and moving out that way. And this is where the data science is not always perfect. But to me, it still kind of says that people saw this change as a negative for property investors in Queensland, and potentially they were looking at purchasing further afield. I mean, our own data is saying that the average distance that people invest from where they live has jumped from 293 kilometres pre-COVID to 559 mid-COVID to over 800 kilometres in the last data set. So it's telling me that investors are prepared to look across the country, and the kind of environment for investors is going to factor into their purchasing decisions. And if you look at the data where we were talking about the percentage of people buying in Queensland, prior to the legislation, it was 40.9%. During, it was 33.6, and post it's 32.82. So people haven't bounced back in. And I think that's because, as I mentioned before, the government didn't repeal it because they thought it was bad policy. They repealed it because New South Wales and Victoria said, we're not going to help you with the data. So they thought they're not going to get it done. And this wasn't the only political party to be talking about making it more difficult for property investors. I know the Greens in Queensland were talking about, caps on rental increases and things like that. And I understand that rental affordability is a real concern. I don't want to sort of take away from that. But what I want to draw attention to is that these policies have probably unintended consequences that are going to exacerbate the problem.
And let's talk about the problem, because, every newspaper that we pick up here in Brisbane, certainly across many cities and towns in Queensland, we know there is a rental crisis. There's been other research done by PIPA, the Property Investment Professionals of Australia, that showed a higher volume of, people have purchased elsewhere as opposed to purchasing in Queensland off the back of some of these proposed legislative changes. We also know that a lot of people from those data sets sold out of Queensland. So the net effect is that we've got supply of rental properties that is reducing at a time where we have this huge record population growth off the back of COVID. We've had record interstate migration. We've got international borders reopened. So we've got international migrants. So the demand for rental properties has escalated at the same time as the number or the volume of rental properties has actually diminished. So is it any wonder that we have a rental crisis? And to your point, Mike, earlier you mentioned that, the Queensland government obviously legislated this land tax, and it was only repealed off the back of a lack of, cooperation from other governments around the country. And yet off the back of that, we've now got proposed rental reforms that are coming into play here in Queensland. We have had changes to the frequency in which rental incomes or the lease agreements can actually be increased. That's been limited now to once every 12 months. So that's, again, another disincentive for investors, although most tenancy agreements do have a tenant in place for 12 months. So it just means property investors, when they can or when they should increase their rent to align with market rent, that can only happen once a year. My point is, all of these things actually are put in place, they disincentivize investors. And for anyone that might have, an amount of money to spend on an investment property, people don't like uncertainty. So if there's a place they can park their money that's going to give them a more certain outcome, that's what they'll do. And your data in terms of the distance that people are buying away from home almost confirms that that's actually happening already.
I think it does. And I think your average property investor is investing on at least a 10 to 15 year time frame, at least sophisticated investors would do. And we're talking about investing in their future so that they can take less of they're less of a burden to the federal government in retirement, because they're probably likely to be self-funded. So this is something that the government in the past has kind of encouraged, but now we're making these 10, 15, 20-year decisions, but it kind of seems on a whim the state governments will come up with these knee-jerk policies to try and show that they're doing something about it. And to me, they're just making the problem worse. A lot of people are talking about, supply being the problem. We need more supply. If there are more houses, then there's more rental accommodation available. And whilst that is true, it's a long lead time solution, right? And it's not just a matter of releasing land. The developers have to be in a position where they see return on their investment as well. And, with so many building company liquidations, with the rapid rise of construction costs, there are a few headwinds in that sector. So to be able to move the needle very quickly, we've got to recognize that the vast majority of rental accommodation is provided by mum and dad investors, for want of a better term. And the ATO tax stats for 2019, 2020 just came out recently, and they're still saying that 71.5% of property investors own one property. So yes, there are multi-investment property owners, but I think if you own 6 or more, you're in the top 0.8% of property investors. Investors aren't the wealthy land barons that they're categorized as being. And I don't think investors need incentives or handouts. I don't think that's the message that any property investment advocate would say. It's just certainty and no disincentives.
Yeah.
Absolutely. And interestingly, here in Queensland, Mike, the number of mum and dad investors that do provide rental accommodation is a lot higher than in other states. 97% of our rental accommodation is provided by private investors and only 3% by our government. And that's a really low proportion of government public housing here in Queensland. So as you said, the supply pipeline, or the long-term supply pipeline for creating new investment properties, or creating new rental properties rather, it takes time. Construction doesn't happen overnight. So the more immediate form of supply would be to get more property investors into the market, but that's just not happening. And in fact, the reverse is happening at the moment.
Mike, another interesting trend in the data is the type of property. And it's a good one to have a look at, because we did talk about this quite a while ago, how Brisbane's changing, and whether it's affordability, yields, lifestyles, things like that. But it's the type of property that people are starting to invest in. So a bit of a shift towards units.
Yeah, it's a modest shift, and we've been tracking that since forever, really. Units had a real kind of renaissance, probably 5 or 6 years ago, but then we saw a big move away from units when we saw some of the cladding defects, the poor people in Sydney that were evicted on Christmas Eve. But units, I think, will continue to be popular when we see, international students coming back in, because you've got to remember, in the capital cities, we saw vacancy rates, nearly hitting double digits in a lot of places, but that's certainly come back. But it's the price point, I think, that's a big driver. So we saw Queensland as being a popular investment location for a number of reasons. One, it had been really a decade of no growth, so it was kind of due, right? I mean, that's not economics, but it sort of seemed like it couldn't stay where it was for that long. But also the price point, before the big boom, we were talking median house prices in Brisbane, under 800K, right? You look at other parts around the country, you just can't buy an investment property in Sydney or Melbourne for the average price we were seeing investors purchase, which was about 680K. So the price point makes a difference, and that's why I think people were going to Queensland, and I think that's why people will invest in units because they want to be in those central locations. There's enough evidence to say that the best capital growth is going to be closer to the action rather than the regional areas. Obviously, there are examples where that's not always true, but yeah, that's an interesting one for us to watch.
And I really like to see that trend has come through in the data, because our on-the-ground observations have aligned with that trend in the volume of buyers that have been looking at that product type. So, off the back of COVID, we saw a lot of people priced out of the housing market here in Brisbane, and if they had a budget of $500,000 or $600,000, they either had to live an hour or more away from the CBD, or we saw a compromise on the product type, and people were starting to look at townhouses or units instead of houses on their own lot. The other thing with units that I think has come through in the clients that we've partnered with is that they do have a much higher yield, especially here in Brisbane. Gross yields for a lot of units, or the median value for gross yields across Greater Brisbane is over 5%. Now, yields like that don't exist in a lot of other locations, especially the East Coast capitals here in Australia. So people were attracted to that, especially as interest rates continued to increase. It made holding an asset a little bit more affordable, less requirement to put in cash. But as you pointed out as well, we saw people start to value lifestyle locations, wanting to be in those walkable areas where they can jump on public transport, be at work in 10 minutes, but then when they come home, have the ability to walk to a restaurant or a cafe or a bar for those lifestyle elements. And I think we're seeing more and more of that in Brisbane. We have grown up from a country town and we are becoming a big city. But as we look forward over the next 10 years, I think we'll see even more of that, especially in the inner 5 kilometre ring, because this is where our Olympic Games is going to be held, and therefore this is where the infrastructure around the Olympic Games that's being developed is actually going to benefit residents the most. So that's something for people to keep in mind. Product type depends on what the area will look like in the future. So it's always important when investing to understand what a city is going to look like, in the future when you're looking to sell.
I think that lifestyle also adds a lot to it. A bit of a touch on, I always sort of tease people about the weather we have here in Brisbane, how it's winter time and it's in the early 20s and it's quite nice. But it's also low maintenance. It's a bit of low risk sometimes for investors. When you buy a house, there's probably or possibly a bit more maintenance involved in it. You've got the yard, you've got the fences and all those types of things. For a unit, there's not as much probably in that maintenance side of it. So for the low risk side for investors, more affordable, better yield, and also probably a little bit less maintenance on it as well.
One thing I'll say, though, is that not all units are created equal. So, as you would know, Mike, there's a lot of those high density units where you've got a smaller block of land with 80 or 100 units piled on top of each other in that high density situation. You've also got units that might be on a nice 600 or 800 square metre block, and there's only 4 or 6 units on that block. So land to asset ratio is still something that investors need to consider if the capital growth component is going to be important to their strategy.
Yeah, I was just about to say the same thing. When we're talking about units, and in a way we were kind of advocating for them, we're not talking about units within a complex of 500. The land to asset ratio makes a big difference. And if you're buying something, let's say it's 3 or 4 units on 600 or 800 square meters, it's going to apply to it's going to attract a greater pool of potential purchasers. And as an investor, maybe you're not selling it, but you still want it to be an in-demand product, right? Because that's going to push the value. But yeah, I absolutely agree that on the yield side of things, investors have been chasing yield a lot more just because, Dr. Lowe has been very busy hammering rates up. Probably a whole nother podcast to talk about that. But people are chasing yields a lot more than they have before. We've seen commercial property become quite popular as well. And some data that I heard this morning, there's a huge downsider move that I see probably happening in the inner ring of Brisbane as well, where PEXA, the online settlement company, we're saying that about 25% of settlements were cash. cash. I mean, that's an amazing figure for me, and that's got to be driven by downsizers who maybe bought their property in the city 20 years ago, whether it be Brisbane, Sydney, Melbourne. If you bought a place in the city 20 years ago, then quite likely you are able to downsize with cash, and that's a huge amount.
That is a huge stat. 25% of settled sales in the inner city being cash. Now, these people are not people that are impacted by rising interest rates, right? These are people that as you've mentioned, have potentially sold other assets and they're not even leveraging. And this is why it's so important to tell the full story. Interest rates don't impact every individual in the same way. And yes, they will have a more significant impact on people who are unemployed or people who are on lower incomes. So it's really important that people are aware of that.
Yeah, and I think it's adding a little bit more venom to the wealth divide. People that are kind of looking at this baby boomer generation, and they're sort of galloping towards aged care costs and expenses, and saying, "Look, guys, you guys had a golden run. You're going to need to pick up the tab a bit more yourself."
Yeah. Another interesting thing that's come out of your data, Mike, is that the average purchase price for investment properties across the country has actually decreased. I'm guessing that's not a surprise to you, given the reduced borrowing capacity that we've experienced over the last 12 months.
That's the big one, isn't it? The serviceability levels, they're proposed to have changed, but they've been the same for quite some time, and the capacity has just been eroded over time. So anyone that's gone to their broker in the last little while, you compare it to maybe if you were doing it 6 or 12 months ago, you've got a lot less ammunition to work with. So I think that's always going to impact things, and I think that's also found its way into the data of people purchasing further away from where they live, because the vast majority of property investors are going to be located, in and around Sydney, Brisbane, and Melbourne. And you're looking at price points where you can get a property at $400,000-$500,000. You're having to go to places like Adelaide and Perth, and we've seen a huge amount of investment go into Perth, for example.
It's been interesting. And I think that, from our own anecdotal evidence, I think a lot of people have been sitting on the sidelines, meaning, they're not prepared to take a big financial risk by buying into a market, especially when a lot of the media story has been negative headlines. And we've just recently had buyers that we'd been speaking to 12 and 18 months ago who are ready to buy now. They were waiting out for, the time when they felt more comfortable, when prices had stabilized, or when interest rates were at or near the peak of their cycle. And of course, no one knows how far interest rates might go, but I think people have a level of comfort knowing we've come so far and that we're not going to, see similar rate hikes over the next 12 months like we have over the last 12 months.
Mike, just on the renovation
cuts, aren't they? Sorry, Scott.
On the renovation side, and we do say to people all the time that you can't change the location, but you can change the house. So the renovation trend, what are you seeing on that side of things? Are people spending, and obviously with construction and everyone being scared about getting builders and all those types of things, what are you seeing on the renovation sides?
Yeah, I sort of make the joke about, from a depreciation schedule point of view, if it's built prior to 1987, i.e. no claim on the original building structure, we want to see 40 or 50 grand worth of works to make a report worthwhile. And I said, used to be able to get a kitchen and bathroom renovation for that. Now it's like a plumber's call out fee. It's been a crazy rate of change. We've seen basically 18%, 20% growth in construction costs over a 12-month period. The AIQS has released some data to say that they were expecting it to increase by about 4.3% from about February, March through to October. So the pace of change is slowing. I noticed the container shipping costs have come basically back to where they were. So we should see that starting to come in. But there is a construction labor shortage, and there's a shortage of construction companies now after such a huge amount of liquidation. But we have seen more money spent on renovations. I don't think the figure is more just because the renovations are costing more. I think there's more appetite for renovation, whether that's because people are buying cheaper assets that need work done and doing it up. But, there's kind of two stories to the economy right now. There are people that are really struggling from the interest rates. Then we've got 25% of people are buying in cash. There are people that are seeing this as a real opportunity to invest in property, to do these renovations and increase the rental yield, increase the valuation of the property and go up. But yeah, in our data, we're seeing in Brisbane, certainly people spending a little bit more on renovations, more than double in the last 12 months.
Perhaps they're leveraging their equity position off the back of the post-COVID boom to add some more value, as you say, and increase those rental returns.
Exactly. What a boom it's been, right? So there's money there available to a lot of investors. If you purchased pre-COVID in Brisbane, drinks are on you. Give me a call. I'm ready to fly up at any time.
Smart investing, I think, if they can do that, make the most of what they've actually benefited from and invest again before it does, I think, probably move again in the same direction. Well, not probably as far, but move in that direction on the way up anyway.
Yes,
I think so. I mean, I always... Sorry, Melinda.
Oh, I was just going to say, I do think that, the long-term outlook for Brisbane still looks very positive and, just based on the fundamentals of low supply and demand that just seems to be consistent, regardless of the broader market conditions.
Yeah, well, I mean, I've got long sleeve shirt and pants on, and I see Scott there with the guns out. So if that's not an advertisement for Queensland, I don't know what is.
Well, you should come on up, Mike. Look, mate, we'll give it a wrap there. Thank you very much again for all of the data you do share with us and the information you share coming on our podcast and share that with all our listeners as well. We really appreciate it and love having a chat to you and catching up when we can. So thanks very much, Mike, for joining us. I'll let Melinda wrap it up and say a goodbye and a thank you. And thanks very much for listening, everyone, and we'll talk next week. Bye for now.
Mike, thank you. We really appreciate your intel and always enjoy the information that you share with our audience. Appreciate your time today.
It's always a pleasure. Love you guys. Thank you. Keep fighting the good fight.
Will do. And for those that want to get in contact with Mike Mortlock, Managing Director of MCG Quantity Surveying. So look them up online and get in touch. Those details will be in the show notes for people to get in touch also. We hope you have enjoyed this episode. If you would like to subscribe, please Google Brisbane Property Podcast. Head on over to your favourite podcast player and hit that subscribe button. We look forward to speaking with you again next week. Until then, bye for now.